Hey guys, welcome back to another video. In this video, I want to talk about the 2023 stock market update. So what I want to talk about today is about how the stock market is fluctuating like there is no tomorrow. So just imagine this. We're now back in 2021 and the stock market is doing its best roller coaster impression. While at the same time, everybody is clutching their portfolios because it feels like their lives depends on it. And fast forward now, well, the stock market for tech companies are doing great. Microsoft is an all-time high, Apple is breaking their own record, and Tesla, well, it's getting there. It really is, just not quite there yet. Well, here's the funny part though. We are in the crossroad, you and I. Are we supposed to, let it be, maybe sit this one out? Or should we scream, sell, and run away from the stock market? Or should we join the stock market and see how far this can go? Well, that's what I'm going to break down in this video. And I hope you watch to the end because I have 5 very good points that I think you would like. And now to my first point, which is market sympathy. So the stock market has actually been through a lot of drama, like a literal roller coaster happening in the stock market. But despite all of that, there was a 27% market growth in the stock market from 2021 to 2023. And of course, there is fluctuation in between buy, sell, buy, sell, buy, sell. But most of the selling happened this year due to economic uncertainty and geopolitical tension. But what's more surprising than that is that in this October, despite having a huge sell because of market uncertainty and geopolitical tension, in October, the S&P 500 has reached its fastest growth in half a century. Yes, we have never seen such a fast growth in the S&P 500 in the past 50 years. And it is all due to 7 great tech companies like Alphabet, Microsoft, Amazon, and Tesla, and like 4 more companies. They did so well that they literally carry the whole S&P 500 to be having the fastest growth in the past 50 years. And now to my second point, which is geopolitical tango. So we all know what's happening in the Middle East. Fortunately for us, their war do not affect the stock market that much because their war is different from the Russian and Ukraine war. The Russian and Ukraine war supplies a lot of things and it blocks the market chain, the chain of all supplies, supply chain. Because Russia can supply a lot of things from food to sand, rocks, whatever. So they cause a huge problem in the supply chain. But unlike the Middle East mostly just affects oil price, which is very bad as well. Oil price contributes a lot to the economy, but it does not affect as much as the Russian and Ukraine war, which is fortunate for us. But if you're wondering, well, should I be worried about my stocks because there's this Middle East conflict? Yes and no. Just know that it won't affect it in as large of a scale as what happened during the Russian and Ukraine war when it's at its most peak. And now to my third point, which is interest rates ballot. So let's talk about the interest rates. It is now at around 5.25 to 5.5%. Just say it's 5.5%. The Fed has decided to put it there. Well, in the past and even now, they are saying we are going to increase the interest rates until inflation comes down to 2%. So the CPI report It's now at 3.2%, which is almost there, but it's so sticky. That's why you will hear a lot of people saying that inflation is very sticky. And that's what I mean. It means that they're coming down, but it feels like you're scrubbing off a gum from a wall, you know? It's not quite there yet. But surprise, surprise, the Fed decided I'm gonna stop the rates hike. Why would they stop the rates hike though? It's not because they think that it's coming down. Of course, yes, partially yes, but then they're doubting because they want to make inflation come down without completely trashing the economy. Because if they keep increasing it, more people will suffer, more people will lose their jobs, which is a problem because it's going to cause recession. And they historically saying nobody wants a recession ever. So they're hesitating because it feels like inflation is coming down, it's sticky. And other than that, I think that the Fed is actually going to make rates keep this way until March next year to keep the tension and make inflation come down without completely destroying the economy. And I also think that this thing affects different countries differently. Some will cause it to strive, and some will make them, not do so well. And now to my fourth point, which is recession tango. So I've already told you how recession will be caused by interest rates. But this word, recession, sends shivers down the investor's spine. Because in the past, based on the historical events, whenever a recession approaches, the market goes down, especially when Fed increases the rates very quickly. And that's exactly what they did in the past year. When they do that, a lot of people would put their money inside bonds, perhaps, or even the bank, and which would cause a insane fluctuation in the stock market as well, which would make a lot of people save money, be very conservative, and then money is not inside the tech companies. I mean, or just any stock companies. No innovation, no growth in the economy. So when they put their money inside the bank or bonds, they'd be very conservative. The economy flow of money gets cut off, which is what basically a recession is. But here's the twist. Just because the recession happened a few times in the past in historical events doesn't mean it will happen again. Well, what does it mean? They always say history repeats itself. I'm not saying that recession won't come but I'm just saying there is a chance it might not happen, because if there's one thing humans are good at, it is adapting. There might be a chance that it will not happen because people know what's going to happen. And even in this past few months of economic uncertainties, there were some predictions that came out logical because it happens in the past, but it ended up going differently. And now to my fifth point, which is investment choreography. So what should we do? Okay, let's just not talk about the market drama anymore. Let's talk about what we should actually do to prepare for it. So the short-term plan is to put our money in a savings account. Yes, I said it will cause a recession, but there's a reason why they put it in there. It's the best choice. Well, if you put it in a savings account, maybe the bank or the bonds, it helps you save the valuation of your money, and it preserves the valuation while at the same time giving you interest. It doesn't literally save the valuation, but it will have interest coming in. So you, instead of having the money's value itself fluctuating and then losing value of it, you get interest with it. So you could earn a bit of money. for long-term plans, you should invest in stocks because stocks has a long history about outperforming bonds and cash. And also, I've heard this very smart person said before that you shouldn't jump ships from stock markets to bonds until the government's bonds outperform the stock market by 6%, which right now is not even close to the case. So as long as you just dollar cost average into your investments in the stock market, and of course, I don't want to repeat myself, nobody does, and we just assume you know this, but a lot of you don't. Do not invest in some random company, and do not invest in a company that you do not fully understand. Invest in the ones that you understand and has a historical event and historical record of good performance. Maybe go try something famous, perhaps Tesla, because Tesla is a rising star, and a lot of you would actually know that. And this is the conclusion. The conclusion is that there are a lot of uncertainties in the market due to economical problems, geopolitical problems. But as long as you don't get confused by the high bond prices, which happens a lot, which is high but not high enough to ditch stocks, because when, like I've said, when the bond price is high but not that high, do not ditch stocks, which has a historical record of beating bonds in performance. Do not ditch it. And also, the S&P 500 is at its sweet spot right now. It is not too high, not too low, just at the right performance that is just going upwards at a very comfortable state. So the whole point of S&P 500 is to let you have an annual 15% growth in your portfolio. It's not an exponential growth, it's a stable one, which is now what it's doing perfectly. Of course, it is carried by 7 tech companies with great innovations and hitting all-time high, but that doesn't matter, because if you invest in the S&P 500, you want the stable 15% growth annually. But in my opinion, okay, I'm not a financial advisor, but I do want to earn money. So I'll say that maybe investing in individuals, tech companies could help you earn money faster. So what's the key takeaway? The key takeaway of this video is to just dollar cost average into your investments. So trying to time the market perfectly, by the way, is near impossible. So don't be disappointed when you don't get it. It is time to, try to dip your toes into the water, try to test the water a bit, and go earn some money. Anyways, that'll be it for this video. I hope you learned something. I hope you enjoyed this video. I hope to see you in the next one as well. So, bye.